Are you looking for a tax strategy that can save you $25, $50, or more than $75,000 in taxes? See, there's a little known strategy that could change the game for you if that's what you're looking for. It's called the short-term rental loophole. It lets you use losses from real estate to offset your W-2 or business income, even if you don't qualify as a real estate professional. In today's video, I'm gonna break down what the short-term rental loophole is, how you can qualify, and how it could save you thousands of dollars in taxes. So first, so that you can kind of understand why this is considered a loophole, let's start with how rental properties are generally treated in the eyes of the IRS. See, under Section 469 of the IRS tax code, rental activities are considered passive by default. This includes most long-term rentals and even mid-term rental properties. And that's where the problem lies. Any losses you generate from passive activities can usually only offset income from other passive activities, not from your W-2 job or not from an active business that you own. There are a few exceptions that let you make these losses non-passive. One common exception is the special loss allowance. You may have heard of this. This lets you use up to $25,000 of passive losses to offset non-passive income. However, this benefit starts to phase out once your income exceeds $100,000 and is completely phased out when your income, or I should say your modified adjusted gross income, reaches $150,000, which basically makes it useless for many high income earners. That leads a lot of sort of high income earners to seek real estate professional status, or it's abbreviated, sometimes called REPS. So REPS allows you to take losses from your long-term rental properties, right, which are passive in nature, and use them to offset non-passive income like your W-2 or your business profits. But qualifying as a real estate professional, it's not easy. To qualify for real estate professional status, you must meet two key requirements. And this is the problem, right? You got to work at least 750 hours per year in a real property trades or businesses in which you materially participate. And you have to spend more than half of your total working time in the real property trades or businesses. To put this into perspective and kind of make it make sense for you, like in layman's terms, a full-time job is typically considered 2,080 working hours per year, right? That's 40 hours per week. So to pass the more than half your time test, you need to work 2,081 hours in real property activities during the year, in addition to your full-time job. This means your total working time would be 4,161 hours for the year, equivalent to working over 80 hours per week every single week of the year. So as you can see, meeting these requirements is extremely challenging if you already have a full-time W-2 job or run a non-real estate business. That's why REPS is often out of reach for most high-income earners who are not solely dedicated to real estate. And that's where the short-term rental loophole comes into play. By the way, real quick, I didn't mention this before, but if it's your first time watching, let me just quickly introduce myself. My name is Navi Maraj. I'm a CPA who helps entrepreneurs just like you save thousands of dollars in taxes through smart tax reduction strategies. I share these insights right here on YouTube and social media, and I also offer a course. You can find out more about that at navimarajcpa.com. We'll talk about that later, but for now, let's get into the short-term rental loophole. So, the short-term rental loophole provides an exception to the usual passive treatment of rental activities. If you qualify for this loophole, it allows you to bypass the passive rules and treat your rental activity as a business activity, even if you don't qualify as a real estate professional. Now, there are two main ways to qualify for the short-term rental loophole. Your average stay must be 7 days or less. So if you have a short-term rental like an Airbnb or VRBO property, the average stay must be 7 days or less. If the average period of customer use for your property is 7 days or fewer, it's no longer treated as a rental property. Your average stay of 30 days or less with some special services provided, that's another way that you can sort of bypass these rules. If your average stay is 30 days or fewer, and you provide what's called significant personal services, such as daily cleaning or concierge type services, your property is also excluded from the default rental activity treatment. If either of these conditions is met, your short-term rental is generally treated as a business activity. And here's the huge benefit with this. If you also materially participate in this business, the losses can offset your W-2 wages and your active business income and other non-passive income that you may have. So you might be wondering, okay, I sort of understand what you're talking about right now, Nabi. I need to get into a short-term rental, one that has an average stay of 7 days or less, or 30 days or less if I'm providing substantial services, all right? But I gotta materially participate in the property. What's that all about? So let's talk about that next. Even if your short-term rental qualifies for the loophole, you still need to prove that you materially participated to classify the losses as non-passive. The IRS offers 7 material participation tests, but for the most short-term rental investors, the following 3 are going to be the most relevant to you. There's the 500-hour test. So you participate in the activity for more than 500 hours during the year. There's the substantially all participation. Your participation in the activity makes up substantially all of the participation in that activity, meaning you're doing almost all the work. And then there's the 100-hour test with more hours than anyone else. So in here, you participate in the activity for at least 100 hours during the year, and no one else, including cleaners or property managers, does more work than you. The 100-hour test is especially popular because it's easier to manage. If you self-manage your property while relying on cleaners or handymen for support, you can still meet this requirement. And if you're married, both spouses' hours can be combined to meet the test. So you could have 50 from your spouse and 50 for yourself. But it's important that you got to keep proper time logs because that's basically crucial to sort of prove and uphold your material participation, especially if you ever face an IRS audit. A regular time log is one of the best methods to use to substantiate your hours. So don't think this is something you could just make up after the fact. Keep that time log. The hours that count as material participation, you might want to know this. They're generally hours spent on activities that impact the day-to-day operations of a property, such as preparing the property for rent, managing the bookings, communicating with guests, remedying guest complaints, collecting the rent, coordinating with the cleaning crew and contractors, and perhaps walking through the property to inspect it on a regular basis. And what usually happens is you might go in there every once in a while and perform repairs and maintenance yourself. So once you qualify for the short-term rental loophole and meet the material participation requirements, you can then take advantage of powerful tax-saving tools like cost segregation studies and bonus depreciation. If you haven't heard of these, let me kind of explain depreciation a little bit. So depreciation is a non-cash expense that allows you to deduct a portion of the cost of your property each year. What's great about depreciation is that it can create paper losses, meaning you can tell the IRS that you have a loss while still generating positive cash flow in your short-term rental. So short-term rentals are typically depreciated over 39 years. However, with utilizing cost segregation, you can accelerate the depreciation by identifying property components that have sort of shorter depreciable lives. Depreciation is a non-cash expense that allows you to deduct a portion of the cost of your property each year. What's great about depreciation is that it creates paper losses, meaning that you can tell the IRS that you have a loss while still generating positive cash flow for yourself. And so short-term rentals are typically depreciated over 39 years. However, with a cost segregation study, you can accelerate the depreciation by identifying property components that have shorter depreciable lives than that 39 years. So for example, you can have tangible personal property like appliances and furniture. Those can be depreciated over 5 years, or you can locate land improvements from that cost segregation study such as driveways and fences, and that can be depreciated over 15 years. Now, this accelerated depreciation results in a large tax loss in the first year that your property is being put into service, allowing you to rapidly access a tax benefit. And what we're doing here is we're utilizing bonus depreciation to write off a significant portion of these costs in the first year. So that 5-year property and that 15-year property, we're not depreciating that over 5 years or 15 years anymore. We're taking the bulk of those items and depreciating it all in year 1, okay? So in short, by combining the short-term rental loophole with cost segregation studies, and then furthermore, by utilizing bonus depreciation, you can create significant paper losses that offset your W-2 wages or other non-passive income, right? Like owning a business, which is ultimately saving you thousands of dollars in taxes, okay? So are you understanding the big picture here? you're a W-2 employee or a business owner and you're looking for tax strategies, right? And you want to reduce your W-2 income or your business income as much as possible. If you invest in long-term rentals or mid-term rentals, it's really not going to work out because in order to take the losses from those properties, right, you can do a cost seg study and use bonus depreciation on those types of properties. But in order for those losses, those passive losses to offset your W-2 or business income, you'd have to qualify as a real estate professional, which like we said earlier, you're not going to qualify for because you already have a full-time job or you have that small business that you operate in, and you're not going to be working over 80 hours a week every single week to the point where your real estate property trade or business is outpacing your W-2 job or your regular business, okay? But the loophole is that you're going to use the short-term rental strategy because short-term rentals aren't considered rental activities, believe it or not, by the IRS. So if your average stay is 7 days or less, or if your average stay is 30 days or less, and you're providing substantial services, then the IRS doesn't even consider that a rental activity. So what you're doing is you're actually conducting a separate business, okay? And so that's the loophole. So what you do is you have the average stay of 7 days or less, or 30 days or less with substantial services. You get a cost segregation study, and then you utilize bonus depreciation to take that 5-year, 7-year, or 15-year property that's been identified in that cost segregation study and use those losses, which might be, $150,000 in depreciation, to offset your W-2 income or business income that you work sort of in your day-to-day business, all right? So, by the way, if you're finding this information valuable, okay, make sure to like this video, subscribe to my channel, and click that notification bell so you just don't miss any, future tax saving strategies. Let me know in the comments if you're planning on taking advantage of the short-term rental loophole or you want to learn more about it. What in this video was confusing that I can elaborate more on a future video. As I mentioned earlier, I help entrepreneurs like you unlock powerful tax saving strategies. So imagine joining clients like Daniela, who save over $30,000 in her first year, or Jeff, who's now saving over $25,000 annually. You could be on your way to similar tax savings in just a matter of weeks. So if you're ready to take the tax savings to the next level, visit my website, it's navimarajcpa.com, or click the link in the description below to learn more and preview the course. I offer a 30-day money-back guarantee, so all the risk is on me, you got nothing to lose. So if you learned something valuable today, do me a favor, subscribe to the channel, click that notification bell, and if you want to watch something, another video along the same lines where I kind of go through an example of this, you can click right here to watch another one of my valuable videos, or I'll see you in the course.